Hi, it's Nero here, buyer's agent and director of Investment Rise. And today I want to share with you what's happening around our different property markets across the country, and then provide 3 reasons why I believe the housing crash, the so-called housing crash, is about to end far sooner than expected, and why the worst of it is already over. Now, if you're someone who's maybe living in certain pockets of Brisbane, Adelaide, Perth, regional Australia, you might be thinking, what property crash? Prices have barely dropped. In some areas, they've kept rising, okay? Maybe if you're someone who lives in certain areas of Sydney and Melbourne, you're like, well, the prices have really dropped maybe only about 10%, where's this so-called massive crash, okay? And so if that's what you're thinking, then this episode is really going to be for you, because I'm going to share some really strong data to back up not just what's happening in the property market right now, but what I expect to happen going forwards. Now, of course, if you are a doomsday person, if you believe that the property market is going to crash, if you've already bought into some of those clickbait-based headlines talking about property prices crashing 30, 40%, whatever the case happens to be, then here's what I recommend. Click away, go listen to something else, go watch something else. You're not gonna like what I have to share here, okay? So if you're still with me, then I'm hoping that you're someone who wants to make property investing decisions based on data and not hype. Okay, so let's get started by first looking at what's happening to our various capital city markets. So here we have the CoreLogic RP Data Daily Home Value Index monthly values as at the 30th of September 2022. Now, I'm going to do something different in this particular episode, because I'm going to go through, yes, the monthly values, but I'm going to go through them for all dwellings, whereas in the past I've often focused on just houses. But I think it's very important, with so much of those doom and gloom headlines out there and some of that negative sentiment, that we look at the whole market as we go through this, okay? So let's begin by looking at Sydney. Now, Sydney, all dwellings, median price have dropped 1.8% last month, okay? For the year, so that's from this time last year, prices have dropped 6%. Now, that doesn't seem very high. However, what we need to consider is the fact that the peak of the Sydney market was less than 12 months ago. And if we're to compare where prices are right now compared to where they were at their peak, you'll find that the drop has actually been much higher, okay? And that's part of the reason why I expect that we're closer to the bottom of the market than many people out there are saying, okay? But more on that in a moment. Let's keep going to Melbourne. Prices dropped 1.1% last month, and for the year they've dropped 3.9%. Again, Melbourne, it's a similar story. If you compare it to compare the median price for all dwellings compared to where they were at the peak, this drop is much higher than what the year-on-year data suggests. All right. Then we look at Brisbane, including the Gold Coast. Last month, prices dropped 1.7%, but they're still up 13.4% from this time last year. Adelaide, prices dropped 0.2% last month, but are up a whopping 19.2% from this time last year. Perth, prices dropped 0.4%, but for the year, Perth, they're up 4.1% from this time last year. Okay, so when you look at this data, it can seem a little intimidating initially, because you're like, well, prices are dropping everywhere. Month on month prices are dropping across all our capital cities. So even the stronger markets, are they about to go into a bit of a downturn? Okay, and so when you look at this, yes, it can seem scary, but when you go through the actual reports and go through what the research director at CoreLogic has to say, it actually paints a very different picture. House price correction could be over by early 2023, CoreLogic. CoreLogic National Research Director Tim Lawless tipped the housing market correction to bottom out in the first quarter of 2023, followed by a swift recovery after the rate of house price decline eased slightly in September, according to the firm's monthly index. However, this sooner than expected turnaround won't be quick enough to stop the Melbourne housing market from reversing all the gains it made during the pandemic, Mr. Lawless told the Australian Financial Review. Now, if you've been following my work for any length of time, you might recall I've often spoken about the fragility of the Melbourne property market and why it's a market that I've always been most concerned about, even when property prices were rising. And we're now starting to see this revealed in what people like CoreLogic are saying. So let's keep going. Sydney's monthly rate of decline eased from 2.3% in August to 1.8% in September, totaling a 9% fall from its peak in January, while Melbourne's monthly price fall tapered from 1.2 to 1.1% and Brisbane from 1.8 to 1.7%. Melbourne dwelling values, which rose by a comparatively modest 17.3% during the pandemic, only have to fall a further 4.3% to return to early 2020 levels, a scenario which was highly likely, Mr. Lawless said. I'd be surprised if it didn't happen, as I imagine another 4% drop in prices is in store for most capital cities during this cycle, he said. Looking at the housing market more broadly, Mr. Lawless said other indicators such as subtly rising auction clearance rates, improving consumer sentiment, and a lower listings environment in spring correlated with the possibility that the correction may be easing. Okay, so it certainly seems that there is some optimism here, but remember, all of this is based on what's happening in the Sydney and Melbourne markets, or at least primarily based on those two markets. Okay, so what do I think is going to happen? Well, the Sydney market has dropped 9.7%. Let's say round numbers 10% on average. Yes, some areas have dropped more than that, but some areas have not dropped anywhere near that much, right? But on average, 10% price drop. Now, the biggest price drop we've had in the Sydney market in the last 50 years or so was during 2017 to 2019. And that price drop was not driven by a global recession or rising rates or anything of that nature. Rather, it was driven by APRA, the Australian Prudential Regulatory Authority, forcing banks to tighten the way they lent money, essentially reducing people's borrowing capacity, okay? That was the biggest drop we had, 15% between mid-2017 to mid-2019. Now, most people, when they're being bearish about the market and they're trying to give you an idea of how much they think the market's going to drop, they're sort of expecting that 15% price drop, okay, on average. Now, we've already dropped 10%. That means there's only about another 5% to go. All right. So if you're someone who's waiting to see, okay, where is the bottom of the market? How are you going to know when prices drop that 5%? The odds are, and this is based on my experience now from helping people invest in property over the last 12 years, most people who wait for the bottom of the market end up missing the best opportunities they could to buy and end up buying in a rising market where there's a lot more competition. And sure, there are still some great opportunities to be had, but they miss out on some of the capital growth that they could have got if they hadn't bothered trying to time the market. Okay, now that does not mean, mind you, that I'm saying that you should now go and buy in Sydney or Melbourne. Look, if you're attached to buying in those two markets, then I believe that really you're going to be waiting until early part of 2023. But if you're someone who is looking to invest in property, you're looking to make your investing decisions based on data, and you're happy to invest anywhere, and you're still trying to wait for the bottom of the market, odds are you're going to miss it. And why am I saying that? Well, there are three reasons why. First of all, as I record this, we've just had our most recent interest rate rise, and it was 0.25%. So let's have a look at these interest rate decisions, okay? And this is from the RBA's website. And what we can see is we had our first rate rise back in May of 0.25%, and then we had 1, 2, 3, 4 months where interest rates were increased by 0.5% each time, and then most recently 0.25% increase. So we've gone from 0.1 interest rate, and this I'm talking about the overnight cash rate here, to 2.6%, okay? So that means that since April, so May, June, July, August, September, October, in the last 6 months, interest rates have risen 2.5%. Here's what I can tell you. Interest rates are not going to rise by 2.5% over the next 6 months, okay? The bulk of the work has been done. Yes, the market and different experts are arguing about where this cash rate is going to end up, but it's not going to rise by another 2.5%. Okay, so therefore, this sentiment, this negative sentiment around interest rate rises is now going to start decreasing. Okay, yes, interest rates are still going to rise slightly, but you're going to see them rise much more slowly, and as I said, nowhere near as many interest rate rises. What that means is that sentiment, people waiting to find the bottom of the market, they're going to start getting used to these high interest rates, and they're going to start making their buying decisions based on interest rates as they are. And this means both homeowners and of course investors as well. Okay, so the bulk of the interest rates rises being behind us, okay, I think is obviously a good thing for the market and good thing for market sentiment. That's the first reason why I think the worst of the crash is behind us. Secondly, there is such an undersupply of property nationwide, okay, and sure, that we haven't seen that come into force right now because of a negative sentiment. But as that negative sentiment starts to turn to be more neutral sentiment or more positive sentiment, and what I mean by that is more people say, okay, I'm now happy to enter the market, maybe to buy my own home or buy an investment property, whatever the case is, you're going to see that undersupply issue flare up a lot more. That means that you're going to have demand higher than supply, and that's going to place upwards pressure on prices. The third reason why I'm saying that the worst of this housing market crash is behind us is because rents are so high at the moment, okay, and rising in so many places because, again, there's just an undersupply of properties, not just for people to live, but for people to rent, okay? This is going to start attracting more and more investors who may have been holding off because they weren't sure how much interest rates were going to rise. But now as we're getting closer to the top of where interest rates are going to be, investors can start managing their cash flow, they can start jumping into the market, and you're going to then see that's going to increase demand as well. Okay, so 3 reasons. The bulk of the interest rate rise is being over, affecting sentiment in a positive manner, the undersupply of property in terms of houses to live, and the juicy rental yields available for so many investors, and that's going to really start creating some positive sentiment in the property market. But again, I'm talking about here from a general perspective. As I said, Sydney and Melbourne, I still think there's a little bit more for prices to drop, but you want to be gearing up if you are attached to buying in those markets. But if you're someone who's looking to buy almost anywhere based on data and you're like, well, I just want to see what the property market is doing, I think the data is pretty clear that the worst of the housing crash is over. It's going to end far sooner than most people expected, okay? And mind you, this isn't new. This almost always happens when there's a housing correction. The housing correction is short, and there is then quite a strong recovery. However, the initial shock factor of rates going up in May has started to wash through. Every buyer or seller has it in the back of their mind that rates will go up, but buying conditions are pretty good for now. It's quite the turnaround from 6 months ago when the market was skewed towards sellers, he said. Regardless of when the market does bottom out, Mr. Lawless anticipated a V-shaped correction. I've always thought there would be a short and sharp correction, as it was a very short and sharp upswing driven by interest rates, he said. The view from economists is that interest rates will top out early next year, and then house prices will stabilize once rates stabilize, which implies the first quarter of next year. So there you go. What's happening around the property market, but more importantly for you, what's expected to happen in the coming few months based on CoreLogic's data and their findings, okay? I, for one, strongly believe in what that data is saying based on what I'm buying for our clients right now and the research that I'm doing on different areas. So if you're someone who's been sort of sitting on the sidelines as a property investor trying to work out when is the best time to buy, it certainly seems like that time is coming up really soon. Hi, it's Nero here again, and thanks so much for watching. If you like what you saw and you're looking for a proven recipe, a blueprint on how to build a property portfolio that gives you passive income, then click the link below this video and get a copy of my book, Wake Up Wealthier, How to Build a Property Portfolio that pays you an income each and every month. Okay, when you click the link and you download your book, you can get both the digital version and the audio version in case you don't like reading. All right, so I used to sell this book for $49, but right now I'm making it totally free. Why? Because I want more people to get this information, and I know that a segment of you will then like what you see in the book and choose to reach out to find out more about our services. But even if you don't, if you're serious about building a property portfolio that pays your passive income, then you really want to get my book, Wake Up Wealthier. It contains the secrets that I have fine-tuned over the last 19 years. It's totally free for a limited time. Click the link below.